Primary and secondary markets enable transactions for transfer of financial instruments. How are they different? Let's get into the nuances of each of these market types and know their roles. Primary or new issues markets are where securities, equity, or debt are created. This is a route adopted to raise long-term capital and involves a direct transaction between the buyer and the seller of the security. They include selling securities through public issues, initial or follow-on, rights issue, private placement, and preferential allotment. The secondary market is where securities issued in the primary market are bought and sold. Secondary markets can be exchange or OTC driven. Securities may be sold through dealers or auctions. In the case of primary markets, the security is sold at a fixed price. The receipts from the sale become part of the capital structure of the issuer. In the case of secondary markets, however, profits or losses occur due to capital appreciation or depreciation of the security. This depends on the demand and supply of this security. Primary and secondary markets in coordination offer avenues to transfer financial instruments from the issuing entity to the first-time owners and further to subsequent buyers. Secondary markets do not provide funds to the issuer. However, secondary markets are an efficient mechanism to value securities by ensuring liquidity. This acts as a firm base for the issuer in case of a follow-on public offering. Further regulations for both exchange-driven and over-the-counter instruments ensure nefarious activities are limited. Thus, secondary markets act as an efficient tool to allocate securities in the capital market, benefiting the economy as a whole. Having a general understanding of the market structure and the difference between the primary and secondary market is essential before investing in securities.